One ship just paid $4 million to skip the line. Not for cargo, not for fuel, just to cross 82 kilometers of water 8 hours faster. And it wasn't the only one. In the last 2 years, companies have paid millions, sometimes more than the ship itself is worth, for the right to cut ahead of everyone else. This isn't a toll, it's an auction. And someone built this machine on purpose. Here's the part that should bother you. The country that built this canal doesn't own it anymore. The country that owns it doesn't fully control what most people assume it does. And a third country wants in badly enough that it has already pulled direct threats from the President of the United States. $4 million for one ship is just the opening number. By the end of this, you'll know exactly who's collecting that money and why a fight over 82 kilometers of water may be one of the quietest, most profitable conflicts on Earth. $4 million for one ship. Keep that number in your head, because everything in this next section explains exactly how a piece of engineered water earned the right to charge it. This isn't just a shortcut. It's one of only 2 artificial passages on the planet built specifically to let global trade skip an entire continent, and the only one that does it through solid mountain and jungle instead of open desert. Before 1914, a ship sailing from New York to San Francisco had exactly one option: go around the bottom of South America, down past Cape Horn, through some of the most violent, unpredictable water on Earth, adding roughly 8,000 nautical miles and weeks of risk to a single voyage. Storms there have sunk ships for centuries. Insurance costs alone made the route brutally expensive before a single cargo fee was ever paid. The Panama Canal erased that problem overnight. 82 kilometers of engineered water cutting straight through the isthmus turned a month-long gauntlet into a transit that takes less than a day. But it didn't happen easily, and it didn't happen for charity. The French tried first in the 1880s and failed catastrophically. Disease and engineering miscalculations killed thousands of workers before the project collapsed. The United States took over construction in 1904, treating it as a strategic asset from day one, not a humanitarian gift to global shipping. Over the following decade, more than 25,000 workers are estimated to have died from disease and accidents during construction. When the canal opened in 1914, it wasn't just an engineering marvel, it was a lever of American global power, controlled entirely by Washington, along with a strip of land on either side that functioned almost like a separate American territory sitting inside Panama. That arrangement lasted for most of the 20th century. Panamanians living next to the canal watched American administrators run it, tax it, and profit from it, while their own government had no direct claim to its revenue. That imbalance eventually became politically unsustainable, and in 1977, a set of treaties signed by the United States laid out a gradual handover. On December 31, 1999, full control passed to Panama. No more American zone, no more American administrators. The canal became fully Panamanian, operated, priced, and funded entirely through a Panamanian authority. Most predictions at the time were pessimistic. Many analysts assumed a small Central American nation couldn't manage a piece of infrastructure that powerful without American oversight. Panama didn't just prove them wrong, it went further than anyone expected. Instead of simply maintaining what it inherited, Panama expanded it. In 2016, a third, wider set of locks opened after nearly a decade of construction, engineered to handle ships nearly 3 times larger than the original 1914 locks could carry. Massive ships, massive liquefied gas carriers, vessels that didn't exist and weren't even imagined when the canal was first designed. That expansion is the real reason this story exists today. Bigger ships mean more cargo per transit. More cargo per transit means a larger toll per transit. and a larger toll per transit is exactly what turned a public utility into one of the most valuable financial assets in the Western Hemisphere. Today, roughly 5% of all global maritime trade moves through this single passage. Container ships loaded with electronics bound for the United States, liquefied natural gas headed to Asia, grain, vehicles, industrial machinery, an estimated $270 billion in trade each and every year, funneled through a channel narrow enough in places that you could see both banks from the deck of a ship. And here is the number that matters most for everything that follows. In the fiscal year ending September 2025, the Panama Canal Authority reported total revenue of $5.7 billion, a jump more than 14% from the year before. Net profit landed just above $4 billion. Nearly $3 billion of that went directly into Panama's national treasury, the single largest contribution the canal has ever made in its 26 years under Panamanian ownership. For a country of roughly 4.5 million people, that is not a footnote in a budget report. It is one of the primary engines funding the entire national government. Which raises an obvious question. If Panama owns the canal, and Panama is the one collecting billions from it every year, why does the President of the United States keep threatening in public to take it back? Part of the answer sits not inside the canal itself, but at the ports on either end of it. For years, a company based in Hong Kong operated key port infrastructure at both entrances, one piece of a much larger pattern. Over the past 2 decades, Chinese state-linked capital has quietly built ports, energy deals, and infrastructure partnerships across Latin America, from Peru's coastline to Argentina's grain terminals, long before Panama's ports ever made headlines. To Washington, the port operator sitting at Panama's doorstep didn't look like an isolated business deal. It looked like the most visible piece of a much wider regional strategy, positioned directly on top of American-built infrastructure. Panama has repeatedly insisted the canal itself was never controlled by China, and the ports are a separate commercial arrangement, not sovereignty over the waterway. But the perception was enough to trigger sustained diplomatic pressure, public threats from the White House, and an eventual shift in who now operates those port terminals. So by the time you reach this point, 3 forces are already layered on top of 82 kilometers of water. The country that built it, the country that owns it, and a rival power that spent 20 years building exactly this kind of foothold across the region. Under all of that political tension sits the actual machine generating the money in the first place, a pricing system engineered with such precision that a single ship can be charged anywhere from $60,000 to $4 million, depending on nothing more than how badly it needs to go first. That system, and exactly how it works, is what we break down next.
Here's how this machine actually works. The Panama Canal doesn't charge one price, it charges a formula. And that formula is designed to extract the maximum a ship is willing to pay, not a flat fee for crossing water. Every vessel gets measured using something called the Panama Canal Universal Measurement System, or PCUMS, a canal-specific way of calculating a ship's earning capacity, not just its physical size. 2 ships that look identical from the outside can be charged completely different amounts because PCUMS measures usable cargo volume, not length or weight. From there, the toll splits into layers. First, a fixed transit fee based on vessel class. A smaller vessel below Panamax size pays a base fee around $60,000. A Panamax-class ship built to fit the original 1914 locks almost exactly pays closer to $100,000. A Neo-Panamax vessel using the wider locks built in 2016 starts around $300,000 before anything else is added. Then comes the second layer, a capacity tariff. For container ships, that's calculated per container slot, whether loaded or empty. For tankers and gas carriers, it's calculated per cubic meter of capacity. For bulk carriers, it's tied to tonnage. This is where the real money accumulates. A fully loaded Neo-Panamax container ship carrying close to 14,000 containers can rack up a base toll well past $800,000 before a single additional fee is applied. And there are additional fees. A freshwater surcharge, introduced during a severe drought that hit Panama in 2023 and 2024, adds a charge based on a ship's length and beam whenever the canal's lakes drop below a set operational threshold. Tugboat assistance for the locks, mandatory pilotage, vessel security charges. None of these are negotiable. All of them are set unilaterally by the Panama Canal Authority, which functions as both operator and sole toll setter for the entire waterway. By the time all of these layers stack together, a large modern container ship can owe well over $1 million just to cross 82 kilometers of water before it has moved an inch. If this is the kind of financial mechanism you want broken down like this every week, subscribe to Capital and Consequence. But the base toll, as expensive as it sounds, isn't actually the most interesting part of this story. The most interesting part is what happens when a ship doesn't want to wait its turn. Most vessels reserve a transit slot in advance, sometimes months ahead, through the canal's booking system. That reservation carries an additional fee, but it guarantees a scheduled crossing, no surprises, no bidding war. But a limited number of slots, typically just 3 to 5 per day, are held back and sold through a sealed bid auction to vessels that didn't book ahead, or that need to jump the existing queue immediately. The base price for one of those slots starts at $200,000. From there, it's a bidding war, and the ceiling is whatever a shipping company decides its time is worth. In late 2023, during the worst of Panama's drought, the canal was forced to cut daily transits nearly in half to conserve water. Backlogs stretched past 100 ships waiting in line. One gas carrier, unwilling to wait another week, won an auction slot for $4 million on top of the ship's normal toll, pushing its total transit cost above $4.5 million for a single crossing. That record didn't stay a one-time anomaly. In 2026, a fresh wave of instability in the Middle East, disruption around the Strait of Hormuz specifically, sent operators scrambling for reliable alternative routes again. Demand for guaranteed, fast transit through Panama spiked once more, and auction prices for Neo-Panamax slots hit that same $4 million ceiling. The canal's own administration has been careful to point out that these prices don't reflect a crisis at the canal itself. They reflect a snapshot of just how much global shipping companies are willing to pay to avoid risk and delay somewhere else in the world. Here's the part worth sitting with. That $4 million doesn't go to a private corporation chasing profit. It doesn't go to a hedge fund or a foreign investor. In Panama's constitution, Panama revenue, after covering operating costs, maintenance, and investment, is required by law to flow into the national treasury. Every dollar collected in tolls, in surcharges, in emergency auction fees becomes public money the moment the ship clears the last lock. Which means that a single company's decision to skip the line doesn't just fund a canal authority, it directly funds schools, infrastructure, and government programs in a country of 4.5 million people, turning a shipping fee into one of the most important instruments of public finance in Central America. So the money is real, it's massive, and it's flowing in a very specific direction. But a toll this expensive doesn't exist in a vacuum. Somebody ultimately pays for it, and it isn't always the shipping company that wrote the check. That's where we go next.
Let's be precise about who actually wins here, because it isn't just Panama in some abstract sense. It's a specific chain of beneficiaries, each capturing value in a different way. The first and most obvious winner is the Panama Canal Authority itself, not as a company chasing shareholders, but as an autonomous government agency with no equity owners to pay, no dividends to distribute abroad, no foreign investors skimming a share of the toll. Every dollar of profit either gets reinvested into the canal's infrastructure or flows directly to the Panamanian state. That structure alone makes the canal almost unique among the world's great shipping choke points. It isn't owned by a private conglomerate, and it isn't managed for the benefit of an outside government. It exists to generate revenue for exactly one country. The second winner is less obvious, and it's the one most people overlook entirely: the shipping companies who are willing to pay. That sounds backwards. How does spending millions of dollars make you a winner? Because for these companies, the toll isn't a cost, it's an investment in certainty. A container ship carrying electronics from Asia to the East Coast might be transporting cargo worth $200 million or more. If that cargo arrives even a week late, retailers miss shipping windows, contracts get penalized, and shelves stay empty during peak buying season. Against that backdrop, a $4 million auction fee isn't reckless spending, it's cheap insurance against a much larger financial loss. The canal has effectively built a pricing system that turns time itself into a purchasable commodity, and the companies buying that time are making a calculated bet that speed is worth more than the fee. The third beneficiary is more structural: global consumers who never think about the canal at all. Even though tolls get baked into shipping costs and eventually into retail prices, the canal's existence keeps a huge share of world trade cheaper than the alternative. Removing 82 kilometers of engineered shortcut would force ships back around Cape Horn or the Cape of Good Hope, adding thousands of miles, more fuel, more emissions, and more time, costs that would ultimately land on the same consumers currently paying a comparatively small premium built into the price of their goods. None of this makes Panama's advantage guaranteed forever. Rivals exist. The Suez Canal offers a genuine alternative for Asia to Europe trade. Investment is already flowing into overland corridors, like Mexico's rail project across the Isthmus of Tehuantepec, designed explicitly to offer an alternative to paying Panama at all. But for now, and for the specific routes that matter most to U.S. trade, Panama holds a geographic monopoly that lets it write its own price, and write it in a way engineered to squeeze the maximum value out of every single ship that has no better option. Notice what this pricing structure quietly does to smaller players. A regional grain exporter with thin margins pays the same non-negotiable base toll as a company backed by billions in market capitalization, but has none of that company's room to absorb a surprise surcharge or a delayed shipment. The canal doesn't distinguish between a corporation that can shrug off a bad week and one for which a single delayed cargo could break its quarter. That imbalance is invisible in the headline numbers, but it's very real for the businesses living on the smaller end of the spectrum. That's the winning side of this story. But every dollar Panama captures in that auction has to come from somewhere else. Somebody is paying that premium, and it isn't always who you'd expect. That's next.
If Panama is capturing that value, somebody on the other side of the ledger is giving it up. The most direct answer is the shipping companies themselves, but that's only the first link in a much longer chain, and the money doesn't stop with them. Start with the companies paying those record auction fees. A $4 million bid isn't absorbed quietly by a corporation's profit margin. It gets built into the cost of moving that specific cargo, and eventually passed down the supply chain, to the retailer who ordered the goods, to the manufacturer who needed a part on schedule, and ultimately to the customer buying the final product. Nobody sees a line item on the receipt that says Panama Canal auction surcharge, but when tolls rise or when congestion forces companies into the auction system more often, those costs move through the economy quietly, hidden inside the price of everyday goods. Then there's a more direct kind of loser, companies that can't or won't pay. During the 2023 to 2024 drought, when the canal was forced to cut daily transits nearly in half to conserve water, more than 100 ships were waiting in line at the worst point, some for over a week. Massive vessels sitting motionless on open water, burning fuel at anchor, crews watching a schedule collapse in real time while the meter kept running. Companies without the cash flow or appetite to bid millions for a faster slot simply had to wait, absorbing the cost of a delayed ship, a missed delivery window, and in some cases, contractual penalties for late cargo. A few companies, including at least one major cruise line, canceled planned routes through the canal entirely rather than risk that uncertainty again. Here's a detail that rarely makes the headlines. Some shippers chose an even more drastic option, abandoning a century-old shortcut in favor of a route their great-grandfather's ships would have recognized. Vessels rerouted around the Cape of Good Hope or Cape Horn, adding as much as 3,000 additional nautical miles and 10 to 20 extra days at sea. That decision avoids the toll entirely, but it isn't free. More fuel burned, more crew wages for a longer voyage, more exposure to weather risk and mechanical strain over a much longer route. It's a real trade-off, not an escape. A company is choosing one kind of cost over another, betting that a longer, cheaper route beats a faster, more expensive one. Then there's a country that rarely gets mentioned in this story at all, Panama itself, on the other side of its own success. The canal generates extraordinary revenue, but nearly all of that value is concentrated around the waterway and its supporting industries. Wealth generated at a national scale doesn't automatically translate into equal opportunity across the country. Critics inside Panama have pointed out that despite billions flowing into the national treasury each year, the country still carries meaningful economic inequality, and everyday citizens don't always feel the benefit of a canal that technically belongs to all of them. The money is real. Where it ultimately lands once it enters the broader economy is a separate and more complicated question. There's also a risk that's harder to price: sovereignty itself. Every time the President of the United States threatens, in public, to take back the canal, Panama is forced to spend political and diplomatic capital defending an asset that international treaty already recognizes as fully theirs. That's not a cost that shows up on a balance sheet, but it's a real one: diplomatic energy, international attention, and a persistent undercurrent of uncertainty about how far a great power might be willing to go over a piece of infrastructure it once controlled. And underneath all of that sits the physical risk nobody can auction away: water itself. Picture the mechanism at the heart of every lock. Gravity alone pulling fresh water from Gatun Lake to lift ships nearly 30 meters above sea level. No pumps forcing it, no artificial substitute waiting in reserve. The canal depends entirely on rainfall to fill the lakes that power that system. A severe drought doesn't care about revenue targets or contractual obligations. It simply reduces how much water is available, forcing capacity cuts regardless of demand. Climate volatility means Panama is, in effect, betting its most valuable national asset on a weather pattern it cannot control. The same locks that generate nearly $3 billion a year for the national treasury can be crippled by a dry season, and there is no toll high enough to make it rain. So the picture is clear. Consumers pay quietly through prices. Companies pay directly through delay or fees. Panama pays in diplomatic pressure and unresolved inequality. And nature holds a veto that money can't override. The only question left is how all of this pressure, financial, political, and environmental, actually converts into power. That's where we go next.
This is the part most coverage of this story misses entirely. It gets framed as a fight over sovereignty or a vague fight over China's global ambitions. But strip away the diplomatic language, and what's actually happening is an auction of a different kind.
not for a transit slot, but for influence over one of the most strategically located pieces of infrastructure on Earth. China's interest here isn't abstract. Over roughly 2 decades, Chinese state-linked companies have built or financed ports, railways, and energy projects across more than 20 Latin American countries, positioning the region as a critical source of raw materials and a growing market for Chinese exports. The port operator that once ran terminals at both ends of the Panama Canal wasn't an isolated business arrangement. It was the most visible node in a network Beijing had already been building for years, from Peruvian copper terminals to Brazilian grain infrastructure. Washington wants assurance that a rival power can never quietly gain operational control near the canal. Beijing wants to keep that same foothold intact in a region it has spent 2 decades cultivating. And Panama sits in the middle, holding the one asset both of them need to stay relevant in the hemisphere, extracting value from both sides simply by refusing to fully commit to either. That's power flowing upward from a small country to a seat at the table with superpowers. But the same mechanism also flows outward, reshaping decisions made by the world's largest shipping and energy companies. Consider what happened after the 2016 expansion opened the canal to Neo-Panamax vessels. Liquefied natural gas exporters in the United States suddenly had a viable, faster route to Asian buyers that didn't exist before. That single infrastructure decision, made unilaterally by Panama, altered global energy trade flows, making American gas more competitive in Asian markets, shifting shipping schedules, and forcing energy companies to build their long-term export strategy around a canal they don't control and can't influence. Panama's engineering choice became other countries' economic reality. Now consider the auction system itself and what it reveals about power during a crisis. When an instability disrupts a different strategic choke point, the Strait of Hormuz, global shipping doesn't simply absorb the shock in isolation. It ripples outward, and companies redirect ships toward Panama for reliability, driving auction prices to record highs. That means a crisis in the Middle East directly enriches the treasury of a small country 7,000 miles away. Money and power don't stay confined to where a conflict happens. They flow toward whichever choke point offers the most certainty. And right now, it's 82 kilometers in Panama. This is the real transformation at the heart of this story. A canal that began as a projection of American military and engineering power in 1914 has become something more interesting. A tool a small country uses to extract concessions from great powers, to reroute global energy flows, and to profit indirectly from conflicts happening on the other side of the world. Physical infrastructure turned into geopolitical leverage. Tolls turned into treaty renegotiations. A shipping fee turned into a seat at the table between Washington and Beijing. The question now is what happens next, whether this balance holds, whether Washington's pressure eventually forces a different outcome, and how much all of this is actually worth going forward. That's where we turn now.
If you've stayed with us this far, subscribe to Capital and Consequence and join us for more long-form documentaries about money, power, and the consequences behind the headlines. So where does this actually go from here? Nobody can predict a geopolitical outcome with certainty, but the available evidence points toward a handful of realistic scenarios, and it's worth being precise about which parts are confirmed and which parts are still open questions. The most likely scenario, based on current diplomatic behavior, is continued pressure without direct seizure. The legal reality is stark. The treaty that transferred the canal to Panama contains no provision allowing the United States to reclaim it, and any military action would violate international law and almost certainly trigger severe diplomatic and economic consequences, not just with Panama, but with every country watching how Washington treats a small nation's sovereignty. Under this scenario, expect more public threats, more diplomatic visits, and continued renegotiation of port operator contracts. Pressure applied through leverage and rhetoric, not force. A second scenario, and one already partially underway, involves deeper U.S. economic entrenchment rather than political control. The shift toward a BlackRock-led consortium operating key ports is a preview of this path. Instead of taking the canal, Washington secures its interests by controlling adjacent infrastructure and ensuring American capital, not Chinese capital, sits closest to the choke point. Under this scenario, Panama keeps full legal ownership, while the practical balance of commercial influence shifts further toward U.S.-aligned companies. A third, less likely but not impossible scenario involves genuine crisis, a dramatic drought forcing capacity cuts far more severe than 2023, combined with sustained high demand from disruptions elsewhere in the world, like the Strait of Hormuz. Under this scenario, auction prices could climb even higher than the $4 million record, and pressure on Panama to guarantee U.S. access during a crisis could intensify sharply, testing the current balance in ways it hasn't yet been tested. It's worth being honest about what we don't know. We don't know whether the current U.S. administration's rhetoric represents a genuine long-term strategy or a negotiating posture aimed at extracting concessions on ports and trade. We don't know how climate patterns will affect Panama's water supply over the next decade, and estimates on drought frequency vary depending on which model you trust. And we don't know whether China will continue seeking economic access to the region quietly or push back more forcefully as its port role diminishes. What we do know is more concrete. Panama currently holds full legal sovereignty over the canal, confirmed by international treaty. The canal generated a record $5.7 billion in revenue in fiscal year 2025. Auction prices for priority transit slots have twice reached $4 million in the last 3 years, driven by conditions entirely outside Panama's control. And control over the ports at either end of the canal has already shifted once from a Hong Kong-based operator toward a U.S.-aligned consortium, a fact, not a prediction. Layer those facts together, and one possible outcome becomes clearer than any single headline suggests. Panama's leverage depends entirely on remaining useful to both Washington and Beijing without becoming a battleground between them. The moment that balance tips too far in either direction, through overt American pressure, a genuine Chinese foothold, or a drought crisis severe enough to threaten reliability, the quiet profitability of this canal could become a very public liability instead. For now, the money keeps flowing, the treasury keeps growing, and 82 kilometers of engineered water keeps deciding outcomes far beyond its own shoreline. What that means for the balance of global power and how this story actually resolves is where we land next.
Let's go back to where we started. One ship, $4 million just to move faster through 82 kilometers of water? By now, you know that number wasn't an accident, and it wasn't excess. It was the visible tip of a pricing system engineered with extraordinary precision, a formula built to extract exactly what each customer is willing to pay, transaction by transaction, ship by ship. The canal itself hasn't changed since 1914 in any fundamental way. What's changed is what it's allowed to charge, who's allowed to profit, and what that profit has been converted into. The country that built it, the United States, no longer owns it. The country that owns it, Panama, has turned a strip of engineered water into one of the most important instruments of public finance in Central America. Nearly $3 billion flowing straight into a national treasury every year, funding a government that a century ago had no claim to any of it. And the country that wants in, China, has already been pushed back once,
replaced at the ports by capital aligned with Washington, without a single shot fired and without the canal itself ever changing hands. That's the real story here. Not a war, not a seizure, a toll. A number on an invoice decided unilaterally by a small country that happens to control something the entire world needs. Consumers pay it quietly, hidden inside the price of everything that moves through those locks. Shipping companies pay it directly, sometimes gladly, because certainty is worth more to them than the fee itself. And great powers pay it diplomatically, spending pressure and leverage they can't get back, just to stay close to 82 kilometers of water they don't control. Money didn't follow this conflict. Money is the conflict, and whoever understood that first was always going to win. If you want to see more stories like this, where a number small enough to fit on an invoice ends up deciding the balance of power between nations, subscribe to Capital and Consequence. If this documentary changed how you think about a place you'd never given a second thought to, leave it a like and consider sharing it with someone who follows money, power, or global trade. And in the comments, tell us this: which country do you think holds the real advantage here? The one that built the canal, the one that owns it, or the one still trying to get in? For viewers who want the full research dossier behind this documentary, the Capital and Consequence dossier is available in the description. Until the next documentary.
Capital and Consequence. Follow the money. Understand the consequences.